Equity Conference, and thank you for joining us. I am Mark Reichman, a Senior Research Analyst at Noble. It is my pleasure to introduce Dr. Tassos Aslidis, Chief Financial Officer and Treasurer of EuroDry Limited. The company's shares trade on the NASDAQ Capital Market under the symbol EDRY. Tassos, the floor is yours.
Thank you, Mark. Thanks for the invitation, and thanks to Noble for organizing this conference and indeed inviting us. I will take the next 15 minutes, about 15 minutes, to give you some highlights of our company, EuroDry, which, as Mark mentioned, trades on NASDAQ under the symbol EDRY. Before I start, you are familiar with this, some forward-looking statements. I'm going to flash this. I'm going to talk about estimates for the future and some other ideas about our strategy. So that's why I need to put out these forward-looking statements to put them under that perspective. Let me jump right in and start describing EuroDry. EuroDry is a company that owns and operates ocean-going vessels that carry dry bulk commodities like iron ore, coal, grains, which we call major bulks, and other commodities that we call minor bulks that include steel products, bauxite, fertilizers, and the like. We concentrate in owning vessels in the middle of the size range of dry bulk carriers from 50 to 85,000 deadweight tons. We call them Supramax to Kamsarmax, as opposed to very large ships called Capesize that carry primarily one commodity, iron ore, and coal secondarily. We feel that by concentrating on the middle range of sizes, we exploit the economies of scale within that size group and at the same time reserve enough trading flexibility for our ships. Currently, we own exactly 12 vessels, but soon we'll own 11 because one of them we have committed to sell and we are to deliver it to its new owners at the end of the month. We also have 2 vessels under construction, which we expect to take delivery of in about 2 years, in the middle and third quarter of 2027. Our company is a continuation of a shipping tradition of the Pittas family that dates its roots all the way back to the 19th century, 1870, if I recall well. The family's involvement in shipping and in the capital markets started with Euroseas, what we call our former parent, of which we were spun off about 7 years ago. All the members of the management team are seasoned professionals, we want to believe, in the sector. Aristidis, our CEO, myself have more than 30 years involvement. Our Chief Administrative Officer, Simeon, has more than 20 years, and the rest of the team has a nice mix of experience and youth. Our board consists of people who have leading positions in their respective fields, and we believe they provide us with sufficient guidance and sounding board to chart the strategy of the company. We manage our ships through a management company that is an affiliate, and that has also a long experience and is well established in the shipping community. We believe we are including the management company, we believe that we're a vertically integrated group that provide ourselves with everything a shipping company needs. I will flash very quickly the list of our fleet. You can see that our fleet consists of 2 clusters, as we say, the modern or new building cluster, which are all Chinese-built ships, 3 of which, the first 3 we built ourselves. The rest we bought, that are mostly sister ships of our Alexandros that we built. We also have what we call a Panamax cluster. These are older vessels, about 20, 21 years old. We sold Irini P, we sold and will be delivered, as I mentioned earlier, to its buyers later this month. Those vessels were the workhorses of their time when they were built, Japanese built. Now they are approaching the latter part of their life, and we're in the process of renewing our fleet. We have sold one of similar ship earlier this year. We committed to sell Irini, and the two ships at the bottom of this table are our two new buildings. It's the ships that we're going to carry on our fleet renewal program. We intend to replace the vessels, the Panamax vessels that are older, with newer vessels like the two Ultramaxes we currently have under construction in Chinese yards. Indeed, this is our growth strategy: to renew our fleet, gradually replace the older Panamaxes with new vessels that are more fuel efficient and more attractive, commercially speaking. We have a challenge to fund our growth. This can be funded either organically by funds that we generate from our operations. The market has not been very helpful up until last quarter, but it seems to have improved a bit, and hopefully if it continues to improve, that would provide us enough funds to fund our new building program. Conceivably, we can issue new shares, but we are refraining from issuing shares in dilutive ways. We want to issue shares only in non-dilutive ways. I'll explain a little bit further down what we mean by that. And of course, we can increase our size and presence by pursuing joint ventures where we establish collaborations at the vessel level, like the two vessels that we bought 2 years ago, where we own 61% of these two vessels and other investors own the remaining 39%. I'll give you some very quick highlights of the dry bulk market. This gives you a very long historical perspective of both rates, which is the blue line on this chart, and also the supply side of the fleet, which is one of a major point in our thesis to remain invested in dry bulk. You can see rate-wise, the market has experienced significant swings. In the early 2000s, we had record-setting rates for this type of ship, a Panamax, in the excess of $70,000. Then there was a miserable decade after the financial crisis. Things changed again during the COVID years, and more recently, down here, we have been at below average rates up until 3 months ago, when rates started improving. I will draw your attention to the red line of the chart, which shows the fleet under construction as a percentage of the fleet at the time. And you can see that the fleet under construction has been quite low for quite a long period of time. From 2021 up until this year, it has hovered below 10% or around 10%, and this is a relatively low level of fleet replacement, which means that the fleet is underbuilt, and that was our thesis, thinking that since supply growth is limited, then any demand growth could create a significant rise of charter rates. Over the last 2 to 3 years, that hasn't really happened. There were some periods in 2024 that seemed to be happening, but then the markets declined, and there are various reasons for that. But demand did not keep its end of the bargain, so to speak. So rates have not really improved. However, the low supply still provides a good base for the market to recover. I will not bother you with some more historical information. I will repeat the point that we have a fleet profile, a fleet age profile, we can see on the bottom left of the slide, that provides significant percentage of the fleet over 20 years, about 10% of the fleet over 20 years. And these ships are likely to be scrapped, especially if the market is not very good, or even more so given the new set of environmental regulation that is being applied on the ships. So with the fleet supply growing at modest rates, you can see on the bottom right the supply growth, or the fleet deliveries, I should say, scheduled for 2026 and 2027. these numbers would possibly be reduced by the amount of ships that are going to be scrapped. So we have a relatively modest supply growth, and then we expect that that would provide the foundation for increases in the charter rates if demand um, keeps its own growth rate of historical average rates. This is a chart that gives you some empirical, let's say, data points about how demand develops. Typically, the dry bulk trade is linked to economic growth. I mean, it's not a statistical results what I'm showing you, but a visual one. And when the world economy did well, then dry bulk trade did well. More recently, there were exogenous factors to this relationship that have to do with the pattern of trade and certain routes being changed. For example, the essential closure or significant reduction of the traffic that goes through Suez Canal due to Houthi attacks on shipping forced vessels to go around Africa and thus increase demand. Earlier, I mean, in 2024, we had some issues with the Panama Canal. All these are additional factors that create uncertainty and disturbances in the pattern of trade. An overwhelming factor affecting dry bulk trade is imports of dry bulk commodities by China. China imports a fair amount of iron ore, imports grains, and exports steel products and other commodities. So it's a crucial driving force for the dry bulk market. Over the last three to 4 years, it has not been at its absolute tip as the infrastructure of China seemed to be saturated, and the Chinese government tried to stimulate domestic consumption and domestic demand in lieu of exports. So really, an investment in the dry bulk market is an investment in China's economic health. As in 2025, and these are some historical information about the main commodities that our ships carry, based on Clarkson, a research firm in the market. In 2025, demand was really not there, at least based on these estimates that were done in the middle of the year. In 2026, certain trends are expected to be reversed, although still iron ore, which is an important contributor to trade, it makes up about 28% of the overall trade, is facing headwinds. Coal is a special case. Coal trade consists of two types of coal: metallurgical coal, which is linked to steel production, and thermal coal, which is linked to power generation. Clearly, thermal coal was on a declining path, given that the world was turning away from polluting sources of energy production and fossil fuels. Of course, the election of Donald Trump has changed that situation potentially and created even more uncertainty of how coal trade will move. But we're looking at these estimates and we expect 2026 to be a better year trade-wise, which combined with the modest supply growth to lead to higher charter rates. Indeed, the last 3 months and even now, rates have been higher, and we hope that if this level of rates continues, we would be more solidly on a profitable basis as far as EuroDry is concerned. Let me move and give you some highlights about our commercial strategy and fleet. This is again the 12 vessels that we currently have in our fleet. The first one, Irene, is the one that we have agreed to sell. But if you look at this chart that shows how the vessels have been employed, all our vessels are employed on short-term charters. Even the last 3 ones that are employed on longer-term charters until middle of next year, the rate is linked to market indices. So if anything, our future profitability will depend solely on how well the market is doing. We are fully exposed to the market. And you can see that on this chart, which links our adjusted EBITDA, the black line, and our net income to the time charter rates for the two types of ships that we have, the Panamax and Kamsarmax and the Supramax, Ultramax one. So we're fully in sync with the market because we don't have all our fleets are exposed to it. We are employed our fleet on short-term charters. To finalize my remarks here, this is our debt situation and some um, highlights from our balance sheet on this and the next slide. We have about 98 million debt. We have recently refinanced two of our vessels, so our debt will probably be a little higher. But overall, we're about 50%, roughly 50% levered. On the cash flow break-even level that you can see at the bottom of the slide, I think our overall cash flow break-even level is about $12,000, which includes $2,800 of loan repayment. And as long as the market is above that, is above 13,000, which is where about the market is currently, we are making positive cash flow contributions and also making similarly positive net income results. Final slide before I open the floor for questions, some summary presentation of our balance sheet. On the asset side, it's very simple balance sheet. We have cash, some advances we made, and the value of our vessels. On the liability side, we have basically our bank debt and some working capital liabilities. So all in all, we have a book value of about 90 million. But at the same time, or $32 per share. Our vessels, though, are worth more than their book value. So on an NAV basis, we estimate that our fleet, our shares are worth about $35, $36 each. We trade at $12.50, so we trade at a deep discount. That presents an opportunity. I mean, you need to know, though, that that discount is a function of the size of the company. We're one of the smallest dry bulk companies, so that probably justifies the discount and the low trading volume of our shares. But if the market recovers as we expect, all boats will be lifted, and our boat, EuroDry, will be lifted more than our peers, and hopefully our shareholders will make outsized or better returns than the market would otherwise dictate. I'll stop here, Mark, and let you ask or coordinate any questions.
Well, thank you, Tassos. So you mentioned that all of your vessels are under short-term charters, and we have seen an increase in rates during the third quarter. So at what point do you start to begin to enter into longer-term contracts to take advantage of higher rates?
That's a good question. I think, let me go back quickly to that chart that shows. I think as I showed you, our cash flow break-even level is about $12,000. That would be net. So as long as the market rates are above $13,000, we are making positive cash flow and net income contributions. I think, as we discussed recently internally, if we see the market being higher, if we can secure vessels at 15,000 or higher, very likely we'll consider securing some of our capacity on long-term charters to lock positive cash flow contributions. I think somewhere in the mid-teens is the threshold for us to consider long-term contracts. Long-term contracts, not necessarily.
Now, you mentioned the decision to sell the MV Irini, which is one of the older vessels in your fleet, that was part of your fleet renewal program. So what are the next steps in your renewal program plan?
I think the next steps is really to execute and fund the existing two new orders that we placed. We have the vessels cost a little bit more than $70 million together, about 36 million each, roughly. So we have made a 10% payment against that order, and we have made arrangements to fund the pre-delivery installments. And generally, these acquisitions will be funded with a combination, as always, of debt and equity. The debt side would be of the order of 60 to 65%. So we need to fund the equity part, which translates to towards that thesis, which had as a result that although the market rates were lower, especially earlier this year or at the end of 2024, prices did not come down. So it was a very difficult decision to buy a second-hand vessel at relatively high prices, while the rates couldn't support this, at least in the near term. This was our thinking when we decided to order those two ships, um, because new building prices have been at a little better levels, comparatively speaking, to the second-hand prices.
Now, the most recent sale of the Irini, certainly improved the company's liquidity, and maybe you want to kind of go through that a little bit. But are you satisfied with your liquidity position, or do you have any positions to further enhance liquidity?
I mean, we do want to increase our liquidity. We are not satisfied. We're okay, but we would like to be a lot more comfortable in terms of liquidity. I think Irini would provide us around 6 million of uh, net proceeds after we pay a small debt that was on the vessel. We have, as I think I mentioned, that we refinanced. We haven't closed yet the refinancing, but we're in the process of closing the refinancing of two of our vessels, which is going to release another 5 million of capital. We have some money in our balance sheet, not much, but we do have some, and we have agreed to finance the majority of the pre-delivery installments for the new building. So we feel we are in control of our commitment, of the requirements of our commitments for the two vessels, but clearly we would like to increase our liquidity, and if the market does not provide it through higher rates, as I mentioned earlier, we might consider uh, selling the older ships and replace them with younger ones.
Well, and lastly, you've mentioned the improved outlook for 2026. And certainly there's been a lot of uncertainty globally, not only, conflicts around the world, but changing trade policies. Um, so what do you think investors should really focus on or watch, in terms of 2026, and are there any risks to your outlook?
I mean, obviously there are risks. I mean, our outlook is modestly optimistic, is not outright optimistic. I think really China is the big factor to watch, and there is hope that if the wars at Gaza and Ukraine stop, then there would be reconstruction efforts that will require raw materials like the ones we carry with our ships. Those would be on the positive side. There are other things that could affect the trade, the tariffs. We don't know exactly what is the final effect and if there would be any. Of course, again, if Red Sea hostilities cease and Houthis are under control, vessels will be able to sail through Suez Canal. That would reduce distances and reduce a bit dry bulk demand, much less in the case of dry bulk compared to containers or other vessels, but it will not be a positive effect. On the flip side, the environmental regulations that continue affecting our fleet, everybody's fleet, could take a bite and result in removals of certain vessels. That would be a positive. It's a quite uncertain environment overall. We're trying to make the best out of it,